Hello everyone. Hi, this is your host Kshitij Maurya from Quantitative. Just wanted to confirm that everyone is able to hear me. So can you just type in into that question panel and confirm you guys can hear me? Thank you, Gustavo. Thank you, Manoj. Thank you, Lou, Abhinav, Arthur, Aman, Khairul, Patrick, Ian, Chaitanya, Bhagwat, Faizan. Thank you, everyone. Thanks for so much of these confirmations. And I welcome you again today to this another webinar that we have in the series of ePatient projects webinars where we invite our esteemed ePat participants from the past who have done amazing projects which are really interesting and are a good learning experience for all of us. So that we thought that we share these experience with you, with all of us, the entire community. The next project is that we have is on systematic G10 FX index by Marti Castany, who is from Spain. About Marti is a quantitative researcher focused on the development of low and medium frequency systematic trading models. His experience comprises derivative pricing and trading, and then over the counter liquidity infrastructure and consulting services for sell and buy side. He's also the founder and portfolio manager of KomaLogic, a proprietary systematic trading firm. And Marti is also one of our esteemed ePatians. So this project will be about the construction of an FX index. And I would pass on the presentation rights to you, Marti, and the stage is yours.
Okay, guys. Thank you, Satish, for your kind presentation. Hope you can see my screen and hear me well.
Yes, I can see your screen and I can hear you very well.
Okay, that's great. So first of all, thank you everyone for being here. Also, I wanted to thank Dion to be an amazing support manager during all the EPAT, and also to thank Nitesh to be my project support manager. So all the experience was actually great, and hope guys you can be you can my project will be useful to you. That was. So let's start. My project was about building a systematic G10 FX index, which I'll be explaining to you right now. But first of all, we need to have the necessary legal disclaimer just to say that this presentation is only for informational purposes. So please don't go and live trade anything that will be explained here. Okay. So now let's go. What this project is all about? The aim of this project was to build an index that could be used as a benchmark, okay, to proxy the G10 FX market performance and in a systematic way. And that's a fantastic phrase, but what does it actually mean? And the point here is that if I ask you what was the S&P 500 returns on 2020, it's actually easy. You go online, you download the data, you do all your calculations, and you can conclude that approximately you had the 16% return on capital during this year on this asset or this instrument. But if I ask you what were the FX returns on the G10 countries in 2020, that's a tricky question. That's not a trivial question to answer. And what I will try to do is to try to answer this question actually. And the goal here is to build an index that any investor could try to use a benchmark to proxy their own performance. Okay, so how can we build an FX index? We can build it, for example, using factors that drive the FX market returns. And one of these, or actually three of these factors could be, for example, the interest rate, so the carry trade, which means, or the underlying hypothesis is that higher yields drives market returns. Then we could use the law of one price, like a value factor related to purchasing power parity. And you will see that this it's something similar like a mean reverting strategy. And finally, the momentum hypothesis, which basically says that if something went up, we assume that it will continue to go up. Okay, so my focus on this project was on the third one. First of all, because it's the easier one, and this is always fantastic. Secondly, is because we don't need any external fundamental data. And this is also great because fundamental data is complicated. You have firstly to obtain it. Sometimes data vendors or the people who publish that fundamental data like to revisit this data and change it over time. So if we download a data set now that has been revised, we won't be using the data that it was actually and really available in that moment in the past if we backtest this strategy. And finally, because the project was extremely too vast for IPAD schedule, and so my project manager don't get crazy on me. So that was the main reason why I was only focusing on the momentum hypothesis. Anyway, I will be explaining these three factors. So this presentation, or at least you can have new lines of research to try this on your own, which I think it could be okay, or at least great. So let's go with the first one, the interest rates and the carry. Okay, first of all, interest rates, which is our hypothesis here? Okay, it's that higher yields drive higher returns. And this is in theory, because as you might expect, markets are extremely complex and lots of variables are playing at the same time. And just making an only statement that will drive returns, it's quite difficult. And the carry could be just one of the things that explain those returns. Okay, so what are the reasons, or what is a possible reason why these interest rates, this carry trade might work? First of all, you have to imagine countries like, imagine you are in the desert and you are extremely thirsty, and there's one country that gives you one bottle of water, and there's another country which gives you 20 swimming pools. Okay, of course you will go to the second one, and that's like our metaphor here. You will want to go to a country that gives you the higher interest possible, and countries with higher interest will be attracting international investors. Okay, if I'm an international investor and I want to invest in that country that gives me higher yields, first of all, I will need to buy the domestic currency. So I can deposit it in a bank of this country, so I can earn, sorry, I can earn the deposit rate. So I'll be buying this currency and the currency will appreciate. But there's one tricky thing in the FX markets is that you can't actually buy one currency without selling another one first. So if I'm intelligent, I can try to go to a country where the lending rate is lower, so I can borrow money from that country and use it to buy the other country's currency. So I'll be using this currency to buy the higher yielding currency, which makes I buy the high yield and I sell the low yielding. So with my trade, I'm making that this exchange rate changes, sorry, and this is the factor which we would be trying to exploit. Okay, so the next one, the value factor. Here, the hypothesis is based on the law of one price, and this is sadly making too many assumptions. Like, for example, there's no shipping cost, and I'll be explaining why this happens. Okay, this hypothesis, how does it work? So imagine that you are in London and you, I don't know, you like chocolate and you buy a cup of hot chocolate, which costs you £1 sterling. Okay, so this same exact product costs 1.5 Swiss francs in Zurich. If you assume that both countries have the same purchasing power, you could expect that the exchange rate from the sterling pound versus the Swiss franc could be that 1.5 Swiss francs. So 1 sterling pound buys 1.5 Swiss francs. But then you go to the real market, you open your terminal, and you see that the current sterling pound versus Swiss franc is about 1.27. I checked this yesterday. Maybe today is higher. So you see that the market is pricing this the British pound versus the Swiss franc at 1.27, but your value model says that this exchange rate should be 1.5. So what can you do? So you can buy you can buy sterling pounds and you can sell Swiss francs. So you will be long the exchange rate pound sterling versus Swiss franc, because what you do is expect that this exchange rate self-adjusts in the future and reflects that imbalance, okay, in value. And as you might expect, this is a mean reverting strategy in which the average or mean price would be that 1.5, and now we are behind below this price, so we would expect to buy this currency pair. And finally, the momentum, which is the factor that I was using to conduct this project, is like the more straightforward of the three. And the hypothesis is actually very simple. If prices are trending up, you can assume that they will continue to trend upwards in the future, which doesn't mean that this is true. Actually, more times than not, it's not true. But when it does, you can use and ride this trend and try to harvest higher profits than the ones that you don't do when this hypothesis doesn't actually holds true. And this one, this is an interesting factor. It's been very studied in academia. It's a factor that it actually exists, and there are some possible reasons which I think I can understand, and that's one of the reasons also why I like to trade momentum strategies, because or at least I think I understand what drives them. And the first of all is, like, for example, mutual funds and hedge funds rebalancing their foreign positions, so they have to currency hedge their overseas exposure. Okay, what does this mean? Imagine that you are an American-based fund and you want to buy European stocks, for example, German stocks. German stocks are sold in euros or are denominated in euros. So you, first of all, need to buy euros in order to buy this stock. So you are long euro. And therefore, you should sell euro to hedge your overseas currency exposure. Because what might happen if you don't do this? Imagine that you win 20% on that German stock, but at the same time, the euro falls 20%. So if you're not hedged, all the profit would have actually disappeared due to the currency risk. And this heavy rebalancing and heavy hedging can drive momentum, which we can try to exploit in a systematic manner in our favor. The second thing is, or the second possible reason could be the behavioral finance, like some sort of psychological bias. For example, following the crowd, overcrowded strategies, things like Tesla or Bitcoin, that when it's starting to go up, people like crazy start to buy again, and this creates more momentum that maybe you can use in your own benefit again. And the third one is the momentum persistence, which this one comes from physics and is actually saying that if something is moving in one direction, it will need more energy to change or stop that direction than to keep moving in the same direction. Okay, so that's all the theory. Now let's try to get our hands dirty and explain exactly this strategy. Okay, we have talked about these factors, and let's do with the momentum factor. How can we exploit this momentum factor? So, for example, we can buy the currencies with positive returns, and we can sell those currencies with negative returns. And this is actually time series momentum strategy applied to the G10 pairs, currencies. So, for example, we can buy the currencies with positive 6-month returns. And why 6 months? It's simple. It's just because it's half a year and this looks sensible. You can actually do it with 12, with 8, with quarters, with 3 months, wherever you want. That is not a problem. Just that we are facing a future strategy in which we need to enter some parameters. The least parameters, the best, to avoid overfitting. And if we try to use parameters that may look sensible to us, so this can help us understand better the strategy. And just to be sure that we are not putting, for example, 3 spot 14 months, which would be kind of weird, for example. And again, we will try to rebalance our portfolio once a month. Again, this is because once a month looks sensible, because this will involve fewer trading costs. And this is actually very important because we can't predict future returns, but what we can predict are actually costs. So if we can keep costs at the minimum, this will help us harvesting our returns. Okay, so as I mentioned, we will be using the G10 currencies, which are the euro, the sterling pound, Swiss franc, both the Norwegian and Swedish krona, the Japanese yen, Australian dollar, New Zealand dollar, Canadian dollar, and finally the US dollar. But of course, these This selection have pros and cons. Which are our pros here? These currencies are very, very, very liquid, and this means that they are cheaper in terms of spread. You know, at more liquidity, the lesser the spread. But this has a very sensible problem too, that these currencies, because they are so liquid, they are actually less volatile than emerging markets. And as you may know, as traders, what we want is volatility in order to make money, because that's our, or at least this should be our goal. And if you buy one currency pair at 1 and you sell it at 1, of course, you haven't done anything, but just making your broker richer, which is not what we actually want. So pros and cons. And again, we will be using the USD as the quoted currency. So the one on the right, okay? For example, the euro dollar. So the dollar is the quoted currency, the one on the right, because this way we can easily compare the returns. That's just the reason. Nothing fancier than this. And you, of course, could also choose another one. For example, if you're based in Spain, as I am, or in Europe, or whatever you want to live, you can use another currency. For example, you can use the euro as the quoted or whatever. Okay, so now let's start working with the data and try to start to see some more interesting things. First of all, we'll be using monthly data because we are rebalancing our portfolio monthly. It's sensible to use monthly data. Of course, you can use minute data, hourly data, or even tick data if you want more granularity. But for the scope of this project, using actually monthly data was more than enough. And the data range was from August 2003 until December 2019, which I updated actually yesterday to April 21 to see like a forward test to see how this strategy would actually have been performing during this special year that we have had with the corona and all this stuff. Another important thing, actually we have 2 degrees of freedom, which are the rebalancing period and actually the time window, which is 6 months. But we will be we won't be optimizing this these degrees of freedom. These variables, sorry. So actually there will be no optimization. So all the data set will act like an authentic out of sample data set, which means, and this is very important, that we won't be cheating ourselves. And we have just one change, okay? If we don't like the results, I'm sorry, that's what it is. But if we use all the data set and then change the results, we've converted our out of sample data set to in sample. So we are introducing overfitting, and this is the worst thing you can do if you expect to make money in the markets, especially if trading systematically. And the other thing is that, as mentioned, we will be using the USD as the quoted currency. And there are other pairs like the dollar yen, for example, which the USD is actually the base currency. So we need to convert all these pairs to our standard format. This is actually easy with this formula that you have here. It's just making the inverse, okay? So now we have the data, we have our parameters, we have all the data quoted with the USD at the right, and then the only thing that we have to do is to calculate the log returns, okay? And why log returns and not normal returns? Just to make sure that we take any compounding that could be inherent in the time series, okay? So because when we rebalance, if we make any profit, the idea is to reinvest all the profits that we're making. So we are actually benefiting of compounding interest. And again, now we have all the returns calculated, and the only thing that we need to do now is to buy the currencies with positive returns over the 6 months, sell the ones with a negative returns, and hold them for 1 full month. And now finally, let's see some plots and some interesting things. And now here we can see actually the individual currency returns against the USD. So that was the reason why we were using the USD as the quoted currency, because now we can compare easily all the other currencies. We can see the euro on the upper side with the New Zealand dollar on the other extreme. What you see here is the white and this. I don't know if you can see my mouse, but well, that wasn't expected. The blue part at the right was that period from 2020 until present day, and the other one is all the data set. But I actually separated it with 70% and 30%, sorry, 66% and 33%, just to have a reference. But as I mentioned, all the data set would be out of sample. So just forget everything about these blue colors. And now let's see the returns of this strategy. It's important to bear in mind that this strategy was computed without costs, okay? Because it's hard to again to go to the past and grab all the interest rate differentials to compute the swap cost, okay, the interest rates cost. And this would be an important cost in our strategy because we are maintaining open positions during 1 month. And in the FX markets, you are charged with the swap, which is called each night. And actually on Wednesday, you are charged with triple swap. So this would be a very important cost that, of course, will drag our returns down. Again, we haven't included any brokerage commissions nor slippage, but in this case, we can expect that slippage would be a small cost because our small trading and our small frequency. Okay, so now, what does this chart tells us? At least it tells that the backtest is profitable, which is no guarantee that the future will be. But we can see 2 straight vertical lines upward, which always it's beautiful to see in a graph, which correspond to high volatility periods. Actually, I was expecting that this strategy performed much better than it did in this period from 2020 until now, because as everyone knows now, we have been through a very volatile year, and momentum strategies are expected to perform well in volatile years. So what could have happened? Maybe we were introducing overfitting just by using this factor, which some other people have told that it works, and this is an implicit form of overfitting. So it will be great to monitor this strategy in the future, but I was just expecting to have a surprise this 2020, but I had not. So I'm sorry, guys. And on the right side, we can see the distribution of returns of this strategy. As is a momentum strategy, we can actually see how we have positive skew, which was actually expected. And finally, this was actually a great project. I enjoyed it a lot. And it was a great opportunity to research and learn about that factors, what drives the markets, and even to drive more in depth to working with real financial data sets, and also facing the problems with fundamental data sets which are not included in the price. And again, our conclusions could be that momentum strategy performs well in volatile periods, but not so well during not volatile ones. We had seen our positive skew of returns, which was something that in theory was expected. Again, we have seen that in this 2020 year period, the strategy was not performing as well as we could expect. And finally, we could use this kind of strategy if we have an existing portfolio and we want to add a hedge to it. And well, if you can then use it with the value and carry factor, maybe when this strategy doesn't win, you can actually diversify among those other strategies and try to reduce your overall volatility. So that's all by my side. Thank you, guys, for your time. And of course, if you want, feel free to contact me. You can do it via Quantinsti, via LinkedIn, or via this email that you have here. So Satish, that's all on my side. Thank you very much.
Thanks a lot, Marti. That's a wonderful presentation. I think you explained it very well, and some of the. So, in fact, so guys, I would like to ask audience, if you want to ask any questions, just start asking them in the questions panel. We already have a few, but before we go there, I would like to select a few questions from Instagram. So yesterday we posted a story on Instagram asking for if they have any questions in advance, and I see that a lot of people who ask those questions on Instagram are attending our session today. So Rahul Panchal asks, so he asked yesterday on Instagram about how to understand which currencies to trade with and how to find spreads. So, Marty, can you help us here with this question?
Yes, which currencies? So how to choose which currencies to trade, and the other one, how to find
And
tight spreads?
spreads. Yeah, that's correct.
Okay. Yeah. Okay. Let's go. For example, which currencies to trade? Obviously, it depends, but this is not a satisfactory answer. So I would say, first of all, look at historical volatility of the currencies and go to the more volatile ones. Another thing you can use to choose currency pairs to trade is how cheap are they to trade, how you can access them, because, for example, in some brokers, you can't trade, for example, the South African rand versus the Mexican dollar. Again, there are countries which you can trade their currency from the outside, like, for example, in Ukraine. So that would be, okay, volatility, cost, availability. And then if you are trading a systematic strategy, you have to bear in mind that different currency pairs reflect different economies. It's not the same an Australian dollar versus the New Zealand dollar, which you can expect a more mean reverting behavior, because they are two economies which depend on each other, and they are actually very geographically close. So you can try to construct your portfolio of currencies, diversifying amongst region, so geopolitical risk and region. That would be the answer. Of course, you always do data mining and choose based on data results, but this would be very, very, very dangerous, because you would be this would be implying some overfitting in your model. And the other thing, how you can avoid, or how was the question? How you can get tight spreads?
So the question is basically how to understand which currencies to trade and how to find spreads. So where to find spreads?
Yes, but finding spreads like for base trading, or the actual spread bid-ask difference?
So basically, in these currency pairs, how do you find? So you talked about currencies which are more liquid. There are less spreads, right? So
Oh yes, okay,
and
okay, 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 okay. So for example,
that
you
way. So
can go. Sorry, Steve. For example, you can go all the G10 emerging markets. You can use this kind of institutional banks definitions to construct your currency basket. So you can differentiate them because of, for example, like developed economies, okay, floating and pegged regimes. You can choose your currencies depending if they have this country exports are dependent or not in commodities, for example. So this could be all ways of choosing currencies.
I think you have like highlighted so many of these parameters, and this really would be helpful for anyone who is actually just getting into the futures trading, forex trading, and who is just starting exploring and want to identify which currencies to pick. So I think these are pretty much very good criterias, and thanks for sharing.
Okay,
So moving
sorry.
on to the
Just if I did not answer, you can always contact me. So feel free.
no, you answered it very well. That's what I'm saying. So time for the next question by Ganesh. So Ganesh asks, logarithms are used for small time frame. If I'm not wrong, then why are using it when backtesting your strategy on monthly data? So that's a question.
Yes, it was because I wanted to. I'm sorry. This is not a very scientific answer, but it was actually because you have to bear in mind that this project was because of the EPAT learning. So we were also trying to get ourselves exposure to different things of doing calculations. But the point was just to bear in mind and have into account the compounding interest, the compounding effect of any time series. Okay.
So yeah, that's a
Yeah.
basically a person.
Yes.
So
Yes.
all right. So I think we are still getting questions, and we are almost at time. So this is the final questions that we are going to pick. And in case any of you are not able to get answer to your questions in this session, feel be assured that we will be reaching out to you with all those answers. So if you have any more answers, you will also be getting a survey form there. You also can share all of your questions, and we'll make sure that all of your queries related to today's session will be addressed. So the final questions that the final question that I am going to ask is from Aman. Aman asks, did you get a chance to plot 10-year historical returns on the benchmark you created?
No, I just plot the entire data set returns, not just the 10-year.
All right. Okay.
Just because I had the data. And again, if you have a huge data set, why not to use it? Okay, it's true that the world is not the same. It was not the same in 2003 that it is today. But at least if you have all the data set, for example, imagine that just at the at the beginning you have one event that if you don't use the whole data set, you don't see, and you go blind and think that your strategy is awesome, and you don't have any tail risk, for example. But that's the answer actually. I use the whole data that I had available.
Okay. Okay. So the data availability, it basically depends on the kind of data availability. So you had that data and you've used it. Yeah. But it's always a good idea if you have more data, you can explore more and you can, get basically backtest your data on that as well. So that's wonderful. So I think let's wrap it up. We are on time, and we're still getting a lot of questions. So before we conclude, I would again like to thank Marty for taking his time out and sharing this wonderful project of his, and all the insights and experience and answering all of these questions, which were also asked on this platform as well as on the Instagram story that we did yesterday. So a lot of questions there we have also got, and we tried to cover them all of in this one particular session. So so we try to keep it crisp, so that there are various things that we talk about, and there are various different aspects to touch upon. Thanks everyone, and you have an amazing day ahead. And for those who are here in India and Southeast Asia, I wish you a very good night. Thank you, everyone.
Thank you, guys. Bye bye.